Okay, everybody, good evening. I hope you all had a nice Mother's Day with your families, or what you could do about it being with your families. And I'm glad you're all here, still safe and well, as we begin the 8th week of our class, the 9th week of quarantine. Hard to believe, time goes by very fast. I was talking with Kathy earlier, and we're amazed at how fast these classes go by every term. A couple of things administrative wise before we get into the lecture of this class. Um, you have, some of you still have to post your quiz number 3 work to Blackboard, and I have spoken with many of you about that, so that's not a problem. I will post the solutions, the grades, by Thursday of this week so you can see how you did. This is the beginning of 3 grades over the next couple of weeks that you all will be dealing with, quiz number 3. And then next week, we have class on the 18th. We're going to be talking about chapter 21. We're going to be doing a review of the final examination, which will be distributed that evening, and due the following week on May 25th, the final examination. Also on May 25th, you have your 10K company selected project paper to be posted. So 2 things are happening on May 25th, our last evening of class. You have your final examination due to be posted and your 10K paper due to be posted. So a lot of work next week. That's why this next week it might be advisable for you to maybe finish up your paper, and then you can concentrate on the final examination work that last week of class. So that's what we have coming up as far as grade is concerned. If you complete all your work and post on the 25th, I will have our course grades posted to Blackboard on Thursday, May 28th. So by the 28th of the month, you will have your entire grades posted and you'll know your grade in the class. But I have a bargaining chip to do those postings of that May 28th grade. And that is, I will post the grade, your final course grade, if you complete your course evaluation. Your course evaluation is located in your My Laverne. Mr. James Shermer has probably sent you all an email to post to complete those course evaluations. You've already done a midterm evaluation, but now you're going to do an end of the term evaluation. Now, again, this evaluation I do not see. I don't know what you write on it. To be honest with you, I'm not part of this course whatsoever. Doesn't affect your grade. It doesn't affect anything. The only thing it affects is it gives us feedback about your opinions about accounting 203 and 500A, and helps us assess the class. My assessment, the textbooks assessment, the platform assessment, and everything. And that's important to us. And so that's why I urge you to complete that evaluation. And if you do complete that evaluation, I will post your final course grade. If you decide not to do the course evaluation, no big deal. Doesn't mean anything. All it means is that you'll get your course grade when the registrar posts it, probably the first week of June, usually around that time. You'll just have to wait for it. If you complete your course evaluation, you get it sooner. That's the only blackmail, I guess you could call it, that I can give to encourage you to do the course evaluation. Let me tell you a little bit about the course evaluation. Just like what you've done for the midterm evaluation, it helps make the program better. It helps make the program better. Now, it doesn't do you much of any good because you're in the middle of the course, you're in the middle of the program. But it makes the program better for future classes, for future assessments of a faculty member, for future assessment, is this the right textbook? For future assessment, is this the right program for you the adult learner in the regional campus administration of the university. Does this fit into what you expect your business administration or your MBA degree to be? So that's why this evaluation is important. I'd like you to consider it and fill it out. But again, it has nothing to do with my assessment of your grade performance in the class. I will not see this evaluation's results until July. They won't have anything to do with or have any knowledge of which you have performed. And in fact, when I do get the results of the evaluation, no names are on it. It's anonymous. It's just your feedback on the course. So that's our timeline over the next couple of weeks. Quiz number 3 grades will be posted later on this week. Your final examination will be distributed to you next Monday. And on the following Monday, May 25th, which just happens to be Memorial Day, sorry about that, you'll have your final examination paper due to be posted to Blackboard and your 10K paper posted to Blackboard.
So
yes.
we have class that night?
We do.
Okay, just making sure.
It won't be very long, maybe about an hour.
Okay.
But we will have class that evening.
Perfect, thank you.
Okay. It will just be a review of all the work in the class and kind of get you set up. I know a lot of you this week are figuring out if you're going to be registering for your summer courses, or maybe you already have. The logical step for you in your business administration program is to take next up after this class, Business 330. Business 330 is called Business Finance. I think what I'll do next week in class, if anyone's interested, I will post the syllabus to that class for you, any of you, to view it and see it next week. If you'd like me to do that, you can see the syllabus for that class. I am teaching it this summer. Sorry to say, but it's online, and I will be teaching it this summer, and it'll be offered to the Burbank students this summer. So,
Professor?
Yes.
I have a question. Because I have to take business statistics, but I will be taking that at a community college, so I could take 3 courses with Laverne. I won't be able to take that course if I'm taking business statistics, correct?
Well, sometimes sometimes it is waived by the university. You can take both courses at the same time. But if you're taking that statistics course at a community college, I don't think that will be, you won't be able to do that.
Okay, I see.
Okay? So
Okay.
if you're taking statistics and finance from a Laverne instructor, I think sometimes they let you get away with that, especially if you have a pretty decent grade point average.
Okay.
Trust me, taking those 2 courses at the same time is going to be a handful.
Yeah, I just want to take as many courses as possible during the summer because I don't work during the summer, so.
Very good. So you'll have time to study and prepare.
Yes.
But still, there'll be a lot of work involved with that class. As I was telling Kathy Campbell earlier, the business finance class is the study of how companies acquire capital. And in that class, there is 3, I called them case studies, Kathy, earlier. They're assignments. There are about 3 or 4 assignments and a paper and a final examination. So I am still sorting that out for this summer because I have to convert that class, which originally was going to be on the Burbank campus. I have to convert that to online. So I'm still working out the syllabus and the course schedule of that. I have taught Business 330 online for many years, but in the context of being converting it from a in-class to an online class, I have to do some adjustments. And so I will be making those determinations in the next week. But so Gabriella, yes, you can do that. It'll be a lot of work, but I know you as a student. I don't think you have much of you'll be okay with that.
Okay. Thank you, Professor.
Okay, but talk to your academic advisor about that. Make sure that if maybe you can work out a schedule where that can be waived or something. I don't know. I'm probably saying things I shouldn't. But at the same time, go ahead and take those courses. If I feel that you would have a problem knowing you as a student taking a finance and statistics at the same time, I would be very frank with you and say, that could be pretty big tamale to chew on. But in this case, I don't think you'll have any problem, Gabriella. So you'll be okay. I don't think anybody in this class will have a difficulty in doing that. Okay, so that's that. So that's our schedule for the next couple of weeks. Now, we have had the point of view during the course of our term of giving extensions to work to give you a couple extra days. That will still be in the context at the end of this month on the 25th. But the latest you can get me your work would be Tuesday, May 26th. I need a full day to grade the paperwork and post it by the 28th. So if any of you do require some extra time, I can give you an extra 24 hours at the end of the month to post your examination or paper and or both if you decided that I can only give you a day due to the nature of the time constraints I have to post your grades to the Blackboard. So keep that in mind as we go forward and finish up the course. Okay. Anybody have any questions in regards to this timeline? Okay, good. All right. Well, you guys are almost done, and you're doing very well. This week we're going to talk about where last week we talked about depreciation, plan assets, liability accounting. We talked about corporations and that sort of thing. And I'm going to do a little bit of review of that in just a minute, just to make sure we're okay. But tonight we're going to be talking about, and I put it into our introduction video for this class earlier today, if any of you have seen that, is the definition of managerial accounting. These next 2 weeks, week 8 and week 9, we're going to be talking about managerial accounting, not financial accounting. And as the textbook says, and as that video says that I posted in their introduction video of this week, the managerial financial accounting is internal accounting. In other words, is external accounting, providing financial statements, review for outside investors, the performance of the company and how they're doing. Income statement, balance sheet, statement of equity. It's a reporting of the operations of the business. Managerial accounting is an internal accounting mechanism, providing information to help the managers of the business make decisions. I'm sure a lot of you with your companies, some of you might be involved in marketing, some of you might be involved in accounting or finance. But one of the key things about business, especially these days, is what price should you sell your product in the market? What price should you provide your product for people to buy it? What should you charge for a service? What should Laverne charge you for tuition? Okay. Now, the nature of making that decision of what to charge a customer is a couple of things. Number one, before you make that decision, you got to know, what is it costing you to make that product? What is it costing you to provide that service? This is what managerial accounting is. What does it cost us to provide products and services? And as you see, Chapter 18 is about classifications of costs. Chapter 19 is about cost accounting, determining and taking all those those cost classifications and wrapping them in to determine what does it cost us to produce something. And Chapter 21 is talking about how much product do we have to sell before we can start making money? All right. That's an important thing for a business to know. One of the reasons why companies today have laid off a lot of people, they know that the revenue stream or the purchases of their products are not there to cover the cost of producing those products. So they furlough you. They lay you off because there's no revenue. When the revenue comes back and people start buying your product, then they know the revenue coming in will take care of the cost of producing that product, and they'll hire you back. And that's what we're doing now. So without managerial accounting, we don't know what it cost us to produce something. Then without that, we don't know what price to sell it at. Now, naturally, the price is also going to be driven by, in the market, how much people want our product, the quality of it, the efficiency of it, the reputation, the brand of the product. But the cost of production or producing a product is very important. And this is what we'll study in chapters 18, 19, and 21 in the next couple of weeks. Managerial accounting. What does it cost us to produce something? So that's the highlight of our discussions. Now I'm going to be perfectly honest with you because I'm a nice guy and I don't want you guys to stress out over this too much. But excuse me. But all the questions you will receive on your final examinations from chapter 18, 19, and 21 are going to be all multiple choice and fill in the blank questions. There's going to be no work problems, no journal entries, no determining an analysis, okay? Just the definitions of these costs, what they mean, how they work, and what are they trying to tell us, all right? So that's what you need to concentrate on in your review. And when we look at some of these problems, is what do I mean by fixed and variable cost? What do I mean by materials, labor, and overhead? What do I mean by break-even analysis? Those are the leading topics of each one of those chapters, 18, 19, and 20. So I'm not going to ask you to put these in journal entry format. I'm not going to ask you to do financial statements. I'm not going to ask you to tell me what their favorable or unfavorable variances are. If you go on and take more accounting courses, you'll be doing enough of that. But this is basically a definition of managerial accounting. What is cost? What is cost of producing a job? What is our break-even point to make a profit? Those are the things we're going to concentrate on, and those are the things you need to concentrate on in your review of this material. And as we go through, and as you read those designated pages from those chapters. Remember, in chapter 18, it was pages 651 to 662. In chapter 19, it was 687 to 696. Okay? So that's what we're going to concentrate on. That's the subject of our study. And that's what you need to be aware of as we go forward. Okay? Great. All right, let me move out of this. And into this. We have a chat question. Chat question is gone. I must have had. Oh, there it is. Barbara's telling me she's going to be in my class next term. You dumb son of a gun. Why are you going to be? I'm teasing. That's a joke. All right, let's bring up this. Sorry. There we go. Let's bring up this. on just for a second. I'm getting my pen in line here to do this. Oh, sec. There we go. Okay. Make this nice and big so you can see it. Okay. So we're going to be talking about managerial accounting, all right? And some of you probably have to do this in some of your work, all right? Some of you, if you're a budget manager or manager of a department, you have to keep track of your costs. You have to keep track of payroll. You have to keep track of supplies. You have to keep track of necessary costs of running your department. That's managerial accounting, all right? But in this section of managerial accounting in chapter 18, we break down our cost classifications. And those costs are two costs. Number one, variable costs. A variable cost. What is a variable cost? A variable cost is a cost that changes with volume. Right? Let me give you an example. An example of a variable cost is payroll, labor. All right. You're going to produce and work a 40-hour work week. The cost is simple. It's 40 hours of work. It's the amount of time it takes to do our work in 40 hours. But at the same time, if we're going to produce or have more work to do, we're going to produce more services, more units, more production. That means that cost is going to go up because we're working more hours. 50-hour week. All right. But on a per unit basis, it stays the same. In other words, if I make $20 an hour, I work 40 hours, 40 hours times $20 an hour, that's my pay. Now, if I'm asked to work overtime to produce more, yes, I'm going to get paid overtime, but the overtime is going to be based on that 20-hour rate. Variable costs are on a here's the definition of a variable cost. Per unit cost stays the same. Total dollar cost changes with volume. In other words, if it costs me $10 a unit to
Close my closet.
excuse me,
Oh, I'm sorry.
how about muting your mic? Thank you. Variable costs per unit always stay the same, but if you produce more product and you're producing more units, that means that cost is going to go increase, but it stays the same per unit. A variable cost changes with output, but on a per unit basis, it's always the same. Then we have another cost called fixed cost. Fixed cost total cost stays the same. But on a per unit basis, it changes with output or volume. Let's make it volume. Let me explain that. What's an example of a fixed cost? I'm on a salary. I'm a salaried employee and I'm in charge of a department. If my staff might work 80-hour weeks and they'll get overtime, but I'm a salary employee, I don't get overtime. I get paid the same amount no matter what the volume is. fixed cost. It stays the same. Here's another example of fixed costs. Insurance. You're going to need insurance if you produce 1 unit or 1,000 units. You're still going to need insurance. That's a fixed cost. Here's another example of a fixed cost. Rent. Rent. I rent a building which I build and work on my company. What goes on in that building means nothing. You're still going to have to pay the same amount of rent. That's a fixed cost. So we break down our costs into 2 areas, variable and fixed. Variable costs change with volume. Fixed costs stay the same with volume. Interesting. And those are the 2 different types of costs that companies manage. If you run a department and you have a supervisor or a boss, and somebody goes, our overhead is too high. We got to cut our overhead. What is overhead? Usually it's fixed costs. Our fixed costs are too high. Our rent, our insurance, our salaried employees. Those are usually fixed costs. And many times companies reduce those fixed costs first. All right? That's an important thing to know. Within these cost classifications, Chapter 18 also talks about 2 other types of costs. Product cost, which are costs associated with the product you sell. Product cost. Your labor to produce a product, your materials used in that product, the overhead associated with that product. Those are product costs. Many times the product costs are in the cost of goods sold. That's cost of goods sold is your product cost, what it takes you to produce your product. But then there's another cost called period cost. These are non-manufacturing costs. They're not determined by the product you produce. They're determined within a certain time period, like your budgeted financial year, 12 months. What's a product cost or period cost? Advertising is a period cost. Marketing is a period cost. HR is a period cost. Accounting is a period cost. And purchasing are period costs. They're administrative costs. Many times companies call these costs S, G, and A. Selling, general, and administrative expenses. Those are period costs. So we're looking at 4 types of costs now that we got to keep track of. This is what drives managerial accountants bananas. You have your variable costs, you have your fixed costs. And within the variable and fixed cost, you have product costs and period costs. To better understand these types of costs, make you more efficient to run your company. I'll say that again. To better understand the nature of these costs in your business, the better you understand your company. Here's an example. My product cost is $100 a unit. That's what it costs me to produce my product. Will I sell that product for $80? If you do, you're not going to be in business very long. The product cost is what you know it costs you to produce that product. And let's say if it's $100, I'm going to sell it for a lot more than $100 because I have to pay for those product costs plus pay for the additional period costs of running my business, plus make a profit. But the product costs give me the basis by which I should determine the selling price of our product. Let me show you an example. Again, if I have $100 product cost per unit, the general rule of thumb in many industries is to mark up that by 50%. So I will sell that product for $150. I'm marking it up 50% over my product cost. My product cost is $100. 50% of $100 is $50. I'm going to sell it for $150. That $150, if I sell that product to my customers, will cover the $100 product cost. Hopefully, and we'll look at this later, will cover my SG&A costs and then make me a little profit. This difference between my product costs and my selling price is called the selling markup. I'm marking it up. Right? To understand your business, you need to understand what this $100 is before you can determine what price to sell it at. So that should be an important definition of Chapter 18. Understanding the definitions of what a variable cost is, a fixed cost, a product cost, and a period cost. Well, now let me bring up a problem from our textbook. All right, let me save this here. Let me bring up, and I have to go into another file folder, guys, on this, so bear with me for a minute. Okay. Here's exercise 18-1. Excuse me, problem set 18-1A on page 679 of your textbook. Problem 18-1A on page 679 of your textbook. The object of this is to take a look at these different types of business expenses and determine whether they're variable, fixed, product, or period. Variable or fixed, product, or period. This is a problem you might see on your examination, where I give you different types of expenses and you have to determine what type of cost classification occurs in. So let's look at number 2. Wages of assembly workers, totaling $82,000. Well, wages of assembly workers are labor. That's going to be a variable cost. Also, because it's assembly workers, they have to do with the product that's being produced. So wages of assembly workers are product cost as well. Variable and product, just like number 1. Let's look at letter number 3. Property taxes on the factory. Property taxes are going to be there no matter what. If we don't produce any units, we're not going to have wages of the assembly workers. If we don't produce any product, we're not going to have plastic for casings. But if we don't produce any units, we're still going to have property taxes. So property taxes is a fixed cost. A fixed cost. And it's considered a product cost. Why? Because it's on property taxes on the factory where we're producing the product. All right? So number 3 is fixed and product. Here's number 4, accounting staff salaries. Accounting staff salaries. Remember our definition of period cost? So accounting staff salaries will be fixed because they're salaries. They don't have anything to do with output. And they will be period costs. Have nothing to do with the product that it's involved in. So accounting for staff salaries is fixed and period cost. Number 5, drum stands, 1,000 stands purchased at $26,000. All right, drum stands. Now remember, drum stands we're going to assume is the product that they're producing, or one of the products they're producing. So I would consider that variable and product cost. Variable and product. Letters number 6, rent cost of equipment for sales staff. Rent cost of equipment for the sales staff. Since it's rent, $10,000, that's a fixed cost. And since it's for sales staff, it's a period cost. Nothing to do with the product. Number 7. Hey, Vince, how about you doing this one for me, Vince? Upper management salaries, $125,000. Is that a fixed or variable?
That's variable. Did you hear me, sir?
I did.
Okay.
Fixed is the correct answer. Why? Because it's salaries. You're not, if a salaried employee is, if you work 80-hour weeks or 40-hour weeks or 10-hour weeks, you still are going to get your salary.
Okay.
Not based on hours. It's a salary. So it's fixed. All right.
Got it.
Product or period cost, Vince?
Product or period cost?
Very good. It's upper management. They make the decision making of the company. They're not producing your product. They're managing. So they would be a period cost. Very good, Vince. Here's another one. Gabriella, why don't you do this one? Number 8, annual flat fee for factory maintenance is $10,000. It's a flat fee for factory maintenance. Variable or fixed?
A flat fee of factory maintenance. Will it be a fixed cost because it's overhead?
Well, it's not, it is overhead, but it's definitely a fixed cost because here's the thing. It says it's a flat fee. It doesn't change. So it's fixed cost. Very good. So it's for maintenance, factory maintenance. Does that be a product or a period cost?
A period?
No, it would be a product cost because it's on the factory where you produce your product.
Got it. Okay.
Okay. Very good. Notice the difference. Upper management salaries was fixed, but it was a period cost because it has nothing to do with the actual production of the cost per unit of the product.
Okay.
The annual
Okay, I
flat
see.
fee is a fixed cost, but it has to do with the factory, then it's a product cost. It would be factory overhead. Exactly right. All right, here's the next one, number 9. Sales commissions. Sales commissions. Barbara, how about you doing this one for me? Barbara. Kathy Campbell, how about doing this one for me? Sales commissions.
So that's going to be variable.
Variable, product, or period?
Product.
Sales commissions.
Then period.
It's period. It has nothing to do with the production of the product. It's selling the product. It's considered a period cost, and it's variable. The more you sell, the more the cost. But it's $15 per unit. Very good. Thank you. And then finally, Barbara, number 10, machinery depreciation, $40,000. Machinery depreciation, variable or fixed? Barbara disappeared. Hello? Machinery depreciation, Barbara, variable or fixed cost? Tori, how about you doing this? Tori, machinery depreciation, $40,000, variable or fixed?
It's fixed.
Very good. And is it a product or period cost?
Product, right?
Exactly right, because it's on the depreciation of the machinery that's producing the product. Very good. So machinery depreciation is a fixed cost and it's a product cost. Okay? So that's a good one. Let me show you something here. And I will post these solutions to Blackboard later on this evening, later after class tonight. But let me show you this. Beg your pardon. So here's the answers to that problem, where we had the determination of variable and fixed, product and period. And this is what we just did. We went down the list and determined what was variable, what was fixed, what was product, what was period. You'll probably have a question like this on the final, where I give you a list of types of costs of a business, and you are to classify those amounts into a variable or fixed nature, product or period. Because if I know which costs are product costs, see all these costs here, 17, 82, 5, 26, 10, and 40, total all those up, that's what it costs me to build my product. If I total up all the period costs, that's my selling, general, and administrative expenses. The product costs have to do with cost of goods sold. The period costs are selling and administrative expenses. If I know the difference between my variable and my fixed expenses, I total up all my fixed expenses, 5, 35, 10, 125, 10, and 40. These are costs that I have to cover no matter if I sell 1 unit or 1,000,000. I have to cover these. I have to cover these fixed costs. Very important. So I have to make sure I understand what is product or period, what is fixed or variable, because these fixed costs are going to be there no matter what. Okay? One of the big problems of running a business is to understand these differences, making sure you know what your fixed costs are, because if you have a lot of fixed costs, that means you got to sell a lot of units to cover them. By knowing what your product costs are, you got to know that's what it costs you to produce the product, and you have to sell it for more than those total costs. that's one of the indications that we need to be aware of in the cost classification. Somebody's microphone is making an awful lot of noise. Who is that?
Professor, it's mine, but it's been acting up, so I didn't want to mute it, but I'll just mute it. Like when you asked me my question, I couldn't unmute the microphone. Sorry about that. But
That's
I'll
okay.
just mute it because I know it's loud in the background. I'm sorry.
That's okay. Thank you. Okay, so that's problem 18.1a. 18.1a gives us a definition of product and period, variable and fixed. And we know we need to know that those definitions. That's the key point of your reading in chapter 18 is what is the difference between variable and fixed? What is the difference between product and period? And what are examples of those different costs? Again, fixed costs are going to be there no matter what. And I need to have a handle on those because as Gabriella said earlier, those are part of overhead. If those costs are not covered by my selling price of my unit, I'm in big trouble. Welcome to the world of retail. Why are so many retail companies struggling these days? Because they have the overhead of the fixed cost of being in a shopping mall. They have the overhead and the fixed costs of the rent on their facilities. Those are high costs. And if nobody's buying any product in those stores, they're going to be in trouble. They cannot meet those fixed cost demands. That's a big problem. Where companies that have low fixed costs, very little fixed costs, I could say one company would be In-N-Out Burger. The only fixed cost In-N-Out Burger has on the cost of them producing a hamburger is probably the rent and the depreciation on their various restaurants. That everything else is variable and they keep those fixed costs low, thus they can achieve profitability a lot quicker. It makes why In-N-Out Burger is very successful. Their overhead is lower than like a regular department store or retail store. Those are key things to know if you're a managerial accountant. So that's the key points of chapter 18. And problem 18-1A is a perfect example of that. Now we're going to do one more problem and then we'll take a little break. And I'm going to ask you guys to take a little bit of time to do this and then we'll go back and run through it after you have a chance to look at it. So let's look at this now. Here's problem 18-2A. And it gives you, again, an example of all different costs of a company. So what I would like you to do, and I'm going to assign you a couple of costs, so you write these down. What I would like you to do is each one of you I'm going to tell you which one I'd like you to do, and I would like you to determine whether that cost is product or period, is variable or fixed, okay? Product or period, variable or fixed. Kathy Campbell, I would like you to do advertising expense and miscellaneous production costs. Barbara Gonzalez, I'd like you to do the depreciation expense on the office and the selling equipment, the office salaries, and the raw material purchases. Tori, I'd like you to do the depreciation expense on factory equipment, the factory supervision, the rent on office space and selling space, product or period, variable or fixed. Gabriella, I would like you to do factory supplies and rent expense. Vince, I would like you to do factory utilities and maintenance expense on the factory equipment. And Mary Ann, I would like you to do the last two, direct labor, indirect labor, sales, and sales salary expense. Which one of these is variable and fixed, product and period, by the definition that we've just been over? So take a minute and take a couple of minutes to look at those and write them down. And when I come to you, you can tell me what each of these costs are, period or product, variable or fixed. Take a few minutes to do that.
Professor,
Yes.
this is Barbara. I got office supplies and selling equipment, correct?
I hope you would have written that down because
I did. I just wanted to confirm that I got that.
Barbara, I think you have depreciation expense on the selling equipment and the factory equipment and raw materials purchased and rent expense on the office space.
Okay. Okay. Thank you.
Hassey?
Yes.
This is Marianne. I just want to make sure that my microphone worked this time before I
Okay.
found it. Okay, thanks.
Okay, Kathy Campbell. You ready? Kathy Campbell. Going once. Going twice. Professor Hassey will do this one. Advertising expense. Advertising expense is a period cost. It is a variable cost. Advertising expense, fixed and variable. Okay. Miscellaneous production costs. Miscellaneous production costs. Product cost. Yes. Variable costs. Yes. Huh? Depreciation expense. Office equipment. Period cost. Fixed cost. Office salary expense. Period cost. Fixed cost. Okay. Barbara, what is depreciation expense on the selling equipment?
On the selling equipment, let me see. I'm sorry, let me look at the question. Depreciation selling equipment. Period?
Is that an answer or a question?
That's my answer, Professor.
Very good. Period
Yes.
cost. Very good. Variable or fixed?
That is variable.
Depreciation expense on selling equipment, how would that be a variable of cost?
Because it is not, let me see. How do I write this?
Remember, variable costs changes with volume. It'll go up or down depending on how much you produce. Does depreciation ever change?
No, sorry, Professor, you're right.
That's right. That's okay. Fixed cost. That's good. Fixed cost. Good. All right, let's do the next one. Raw material purchases. Raw material purchases.
That's a product, right?
Product cost. Very good. Variable or fixed?
I believe that's variable because the raw material, we don't know how much we have of it, right?
Well, raw material means if we want to produce more, we're going to buy more. If we want to produce less, we're going to buy less. So it's a variable cost.
Okay.
Okay. Good way to go. All right. I think you have two more, right? You have
Yes.
depreciation on the factory equipment.
Yes. Oh wait. Yes. Oh wait. I thought it was factory. Oh yes, I do. You're right. Product. That's a product.
Depreciation, it's very good. That's a product cost, fixed or variable.
And that's a fix because it's depreciation.
Very good. Excellent. All right. And the last one for you, Barb. Rent expense on the office space.
I thought mine was factory supervision, Professor.
Say that again.
I believe you told me it was factory supervision. That's what I have here.
Factory supervision. That's way down below there.
I could do that one right now.
What?
I didn't do that one, but let me figure that one out right now.
Okay, very good. Rent expense on the office.
Okay. That is rent. That is, let me see. Let me look at my books. Sorry, Professor. Rent.
Rent on the office.
Office space. That's period, correct?
Very good. It has nothing to do with the production of your product. Very good. Variable or fixed?
That's a fix.
Very good. Rent is always a fixed cost. Good job. Nice work.
Okay.
All right, Tori. Let's
Yes,
see. You have, how about factory supervision, Tori?
Factory supervision is a product. Or, yes, product, sorry.
Very good. Fixed or variable?
And that is fixed.
Very good. Nice
The
spelling.
selling, the
Right,
rental.
and now,
selling
Tori,
space.
you have rent expense on the selling space.
So that is period. And it's fixed.
You are on a roll. Good job. Did I ask you to do another one?
The factory supply is used.
Factory supplies. Okay, factory supplies.
And it's, I don't know if this makes a difference, but it says indirect materials. So that is a product.
Very good.
And I would say that is a variable.
Very good. Excellent. Good job. And then the last one, how about rent expense on the factory?
So that is going to, I want to,
You gave me that one, Professor.
yeah.
Who's that?
You gave me the factory supplies used, indirect
All
materials.
right, go
and
ahead.
used
Go
rent
ahead.
expense.
So, all right. So, Gabriella, we're going to do the rent on the factory building.
Yes. So rent is always fixed. And then I got product cost.
Very good, because it has to do with the factory where the product is being made. Very good. How about factory utilities? Who has that one?
That's me, Professor. For factory utilities, I have product and fixed.
Product and fixed. That could be a difficult one. If we're producing more, wouldn't we be using more utilities?
Yes.
I think that would probably be a safer assessment to say that's a variable cost. It's just like I just got my electric bill for the month of April. And because my wife and I are home all day, our electric bill was unbelievable because we're home all day, because we're in the home. If that, so that could not be considered a fixed cost, because if you're there using it, you're going to use it more, right?
That's right. Yep.
Very good. So that would be a variable cost. Good job. All right. Vince, did you have anything else?
Yes, sir. I had maintenance expense, and for that, I have product and variable.
Maintenance expense on the factory equipment, that would be product and variable. Exactly right. We produce more, we're probably going to have more maintenance costs.
Right.
Clean up more. Very good. Good job, Vince.
Thank you.
All right, Marianne, direct labor.
So for direct labor, that would be a variable expense. And it would be a product expense.
Very good. All right, and that's, how about sales?
Sales would be a variable expense, and it would be a product expense.
Well, I think they probably pulled a fast one on you here, Marianne. I think sales there are considered revenue. 4,942,000. I would think if I looked at that, it doesn't say, notice it doesn't say, like below it says sales, salary, expense. It doesn't say rent on the selling space. It just says sales. So I think that might mean revenue. What do you think?
Sure.
Professor, does that mean that it doesn't fall under neither of them?
That's right, because it's revenue.
Okay.
I think they're kind of pulling a fast one on you there.
Okay, I was thinking more like cost of goods sold.
Well, that would be, yeah, well,
I don't know.
it probably should say cost of goods sold.
Yeah. So I guess I got a little thrown by it. You're right. So
Yeah, that's kind of a curveball one. That's one that Professor Hasse will never give you.
okay.
That makes you like, well, you could answer that a variety of different ways.
Yeah.
So
So
let's,
we're gonna go with revenue instead of expense.
yeah, so we'll just
Okay,
skip
neither.
over that one. Okay.
Okay.
All right. How about indirect labor?
That would be a fixed expense and it would be a period expense.
Indirect labor. Because it says, now you might have read this in the chapter, you might have not. But indirect labor is considered overhead of production. It's like, here's an example of indirect labor. It's labor on the assembly line that's not actually putting the product together, but you need it to, it might be maintenance people, labor and maintenance.
So it's not like administrative labor.
Right.
Okay.
Whenever you see the word labor, you got to think product.
Okay, I got you. So
Okay.
then that would be variable and product.
Very good. Good job. And then finally, sales salaries expense.
Would be fixed in period.
Very good. Very good. But this can get kind of hairy after a while, and you have all these different costs, period, and fixed. Very good. Okay. So again, these are all examples of costs of production, period, variable, fixed. And now I know a lot of you guys, who gives a poop, whether this is sales or variable or fixed or whatever. The key thing here is that you have to, I'm sure some of you work for companies and you see these people running around called internal auditors or cost accountants. Their sole job is to organize the cost of the business into groups like this. What are product costs? What are period costs? What are variable costs? What are fixed costs? Because the fixed cost, especially when they have to do with product, are manufacturing overhead. The fixed costs that have to do with period are administrative overhead. Costs that are not going to change no matter if you produce 1 unit or 10. So it's good to isolate those and know what they are. When I used to run my own company, the first thing I did every month was total up my fixed costs. And I always monitored them because those fixed costs I considered the Darth Vader of my costs, meaning I had to pay those no matter what. If we didn't have any business that month, then I didn't have to pay too many selling commissions. If we didn't have much business that month, I didn't have to pay too much labor on the clients. But if I didn't have much business that month, I still had to pay all those fixed costs. So it's all very important to get a handle of those fixed costs. So good job. So that's the definitions of chapter 18, splitting these down and all the different costs associated with doing this. Very good job, everybody. So I'm going to save this and post it to Blackboard so you have it as a reference. But I would be familiar with the definitions of product, period, variable, and fixed. So let's take a break. And when we come back, we'll talk about chapter 19, the cost of per unit, labor, materials, and overhead. We'll talk about that, chapter 19, when we come back. I'll see you guys back in about 10 minutes. We'll see you then.
Hey, Professor, this is Kathy. Can you hear me now?
I can.
Okay, I don't know what happened earlier. I was talking, but it didn't seem like you were hearing me.
No,
So